Welcome to Views from the North, a Canadian rates and macro podcast. This week I'm joined by Chris D'Onofrio, one of our Canadian dollar swap traders. This episode is titled Rose-Colored Canada. I'm Ben Reitzes, and you're listening to Views from the North. Each episode I will be joined by members of BMO's FIC sales and trading team to bring you perspectives on the Canadian rates market and the macro economy. We strive to keep the show as interactive as possible by responding directly to questions submitted by our listeners and clients. We value your feedback, so please don't hesitate to reach out with any topics you'd like to hear about. I can be found on Bloomberg or via email at benjamin.reitzes@bmo.com. That's benjamin.reitzes@bmo.com. Your input is valued and greatly appreciated. Chris, welcome back to the show. Always a pleasure to have you.
Thank you. Thanks for having me.
Chris
Realize it means you've reached the bottom of the rotation.
Completely untrue. Chris is actually a really smart guy. So what actually happens is I do look at who's been on recently. But Chris is one of the people that I do like having on because he can drive the conversation, not just me, and he'll ask me questions too. So I like that. It makes my job easier. And it just means less talking for me, which I always enjoy since I'm the one that usually has to talk more. So where should we start, I guess? It is April 15th, late afternoon, I guess now. And it looks like the war is mostly over.
Waning would be the word I would say.
Waning, sure, that works. The ceasefire already looks like it's going to get extended. The appetite for conflict appears to have diminished on both sides, actually, no matter what the headlines might say. And markets are reacting accordingly. Stocks back at, the S&P 500 hit a new high just a few minutes ago. And risk assets globally looking happy.
Yeah.
And rate premium kind of coming out of the market a little bit from where we were. How do you view things now?
Yeah, to your earlier point, I think we've very much peaked in terms of our sensitivity, at least. Even if the war isn't completely over, we very much peaked in terms of our sensitivity to news about the war. It feels like that, I would say, over the last 3 or 4 sessions. So, yeah, I think people are starting to take a step back, or have started to, I should say, over the last week, and take a step back and kind of analyze beyond just, there's a headline, we need to buy or sell and figure out the rest later. So on that note, I think to your point, the outright rate premium that's retraced, I think is okay now. I think we're at a level, at least in the Canadian curve, where things are kind of back to where they were a month and a half ago, at least in terms of the belly. I'm talking 3 to 7 year part of the curve, which I think is what got hit the hardest over the last couple of weeks. So I think we're at a point where outright levels are starting to make sense again. You have things like 2-year, 1-year, and 3-year, 1-year kind of in the high twos, which I think is okay. I just think the shape of the curve is something where there still remains some low, or at least lower hanging fruit in terms of trades. You're not making 30 or 40 basis points on your outright rate move like you might have been 2 or 3 weeks ago when things were really crazy, but there's still some pricing, particularly in the kind of 0 to 4 year part of the curve, that doesn't make a lot of sense to me.
Okay, how many rate hikes should be priced for this year? Do you think?
I think 0, but okay. But people, that's a subject of dispute. I think we are where we were pre-war in terms of things like 2-year, 1-year, 3-year, 1-year. But the important thing to remember is pre-war, we didn't have those multiple very weak data prints that we have now had, right?
Yes.
Let me ask you this, no war and we got the last 3 data prints, would we have cut, or would we be cutting in April?
Probably not April. June was possible, but so June would have been possible on the back, I think, of inflation rather than the growth side of things. The growth side is, the Canadian data are volatile at the best of times. And so we got the really good December numbers, or the really good job print in December. And that kind of crushed the market and drove a massive sell-off and pushed rate hikes into the pricing. And then things went pear-shaped.
We got the opposite, right?
Total other way in January and February. And now it's coming back the other way. It was a little more mixed in March. There were some soft spots for the January numbers themselves. But January GDP was positive. And the February flash for GDP was even more positive, so plus 0.1 and plus 0.2. And now the data we're getting for February are actually pretty decent. We got February manufacturing and wholesale, and both of those were really good mostly on the back of just auto plants restarting after some maintenance and retooling. and you're going to have maybe a really good month of February. And so it's kind of like it's a very uneven growth profile for Canada. So like we had a good third quarter, bad fourth quarter. Q1 will probably be okay. I don't think it'll be great. I think it'll be okay. And it's just not clear to me that the economy really is falling off a cliff at all. We're just kind of stalled, waiting for some resolution on trade. And lower rates are not really going to help. What they end up doing is what they did last year is kind of, I think it puts a floor under things. It just helps kind of sustain this sideways momentum, let's say, where consumers are still spending, not aggressively, but they're still out there. And the reality is what's keeping the economy afloat for now is really just government spending.
Yeah.
And the stimulus side of it is going and is going to continue to. And I think it's probably underappreciated on how much support the government is providing at the moment.
Yeah, I would agree with that. And the thing I would add to that is, like, I know the Bank of Canada is a separate entity from the government, but they operate quite closely, at least they have historically. So politically speaking, I mean, I think the bank has showed us over the last number of years that they want to err on the side of incremental support to Canadians rather than...
They've already done that. I'd say they've already done that with going down to 225. They've done that. So if inflation were to, so let's say the war didn't happen, you got another good inflation print, they would have been happy to provide more support because what they're trying to do is effectively provide as much support as they can given the inflation backdrop to help the economy through this difficult time with trade. But that inflation backdrop no longer exists. The oil price spike, how much that spills through into core, they don't know. I don't know. Anyone who says otherwise is probably not telling the full truth or lying altogether. And so we'll see what happens over the next few months. But like I'd say the window for cutting probably closing pretty soon. Like unless you get some kind of negative outcome on trade, but if you think that there's going to be something will happen on trade at some point in the summer, like rate cuts probably would have had to been like April, June, maybe July. It's not going to be April. It's probably not going to be June because oil prices probably aren't going to retreat as much as we'd like. And we're not really going to know the full impact until probably much later than that. And then, so I guess you could maybe get into July, but by then maybe we have a little more clarity on where trade's going. And they're just going to be like, you know what? Maybe we don't need to provide any more support here. Let's see what happens with trade. Listen, if it goes pear-shaped, fine. We'll cut more. Yeah, I agree. But if there's a deal, growth can flip pretty quickly. You might get business investment picking up in a hurry for all the investment that's been deferred over the past kind of 15, 18 months. And the backdrop can change pretty quickly. And so if the rate cut window is kind of closing now, the optionality should be the other way, which is why I think it's reasonable for us to price one hike by the end of the year, because that's kind of where the risk is starting to tilt. The odds are long that we get that hike. I think that part I'm with you, but that's where it is. And if the risks are skewed that way, you need something priced. Maybe 25 is too much. But
15 or 20 maybe.
Sure, but like I mean, where we are now, we're at 35-ish. That's too much. I'd say like, but the risk reward isn't there. Like given the volatility around headlines, do you really want to be in a trade that could, I mean, I think could sell off 20 basis points easily, and it could 1-to-1 at best if you're lucky.
Yeah.
If you're lucky.
That's kind of why I said before, like I like kind of more macro RV curve type trades right now because I don't have as much of an issue with outright pricing. I do think the risks are a bit more symmetric in 2026 than it sounds like you do.
Okay.
But particularly when, like, I know we claim to be a single mandate central bank, but I don't think that's true. And we have 6.7% unemployment. So, but sure, there was at least within 10 or 20 basis points of what I think is reasonable. So that kind of, to my earlier point, means the attention should be more on where that positive slope, where that risk premium is being put in the curve. And right now, I think it's a bit too front-loaded, quite a bit too front-loaded, if you ask me.
Okay.
So kind of my point here is that suppose you're right in that 20 basis points and 25 basis points within 2026 is correct. Okay, fine. But what does that mean for, 1 year forward and 2 year forward gaps? Probably means they should be quite a bit higher than they are right now, doesn't it? Yeah. So that's kind of what my preferred trade is right now, right? Is like, you want to be long something in the whites. I don't know what it is, but if you're wrong on that, then surely the blues and the greens should be a lot cheaper than they are right now, right?
I would think.
So yeah, like you look at something like my favorite expression is Z6 versus 2 year, 1 year, but anything kind of in there I think makes sense. But take that as the example. You look at that, and that curve is only worth about 25. I mean, we sold off today, so maybe it's more like 28 basis points today, which, like, if you believe that we're reigniting growth and there's going to be some Goldilocks trade deal or whatever it is, oil stays up here and that's great for Alberta, whatever the catalyst is, it's very difficult for me to say, okay, we're going to hike once or twice in the next 8 months, and then we'll maybe hike one more time in the next 3 years, and that's it. Like, that just doesn't seem reasonable to me at all.
Yeah, I can't really argue too vehemently against that. The one side of this that gives me some pause is we are in modestly or slightly stimulative territory at the bottom of the neutral range at 225. The middle of their range is 275. So I can very much see a world where they get back to the middle and they don't really do a whole lot after that. That's not a crazy outcome. I think you usually see when growth picks up, it usually keeps going. And then you get some positive feedback loop and it keeps going. And then you get rates pushing even higher than that and they need to be restrictive, but maybe not. Maybe growth doesn't pick up the way that it sometimes has in the past, and productivity stays weak in Canada, even though I think that is not true. And I can just see that world is pretty much all I'm saying. Like that's reasonable. But I
right. But how long could that like?
Yeah, and even then you'd still want some
even then maybe it's 1 year forward.
You still want some premium in the curve. You still should have some slope there.
Yeah,
you should.
Yeah.
Like the direction from that point is probably the risk is higher rates, not lower for sure. And so you should have a steeper curve in that part. Yeah, I'm with you.
Yeah, that's kind of what I'm driving at.
I agree.
Which is really kind of just a fancy 2.5s, I guess. But
that's okay.
But I think that's where the money is right now.
Okay. I don't mind that. Well, I don't think we'll get a clear picture on the bank for a while. They're probably going to stay pretty cagey, I would expect. The government's done them a favor. Got the gas excise tax cut coming into effect next week. It's only 10 cents, but on a $1.80, it's probably even lower than that now, at least the national price. But on a $1.80, it's up to 5.5% or so. Cuts inflation a couple of ticks. That is good policy, I think. It kind of reverses the stagflationary impact of higher energy prices. It cuts CPI, puts some money in people's pockets. Good policy. I like it. I would have done that myself. And so favor for the Bank of Canada, I think. Carney being a former Bank of Canada governor, I think probably helped in this equation, helps them on the inflation side.
Yeah, it's just, I mean, I said this before, that kind of just goes to my earlier point. Like, it really feels like
they're in cahoots.
Regime, well, sure, but also just like they're very much incentivized to show that they are here to support. They want to err on the side of support. I think.
Always.
They always want to err on the side of support.
That's their job.
So
their job might be 2% inflation, but it's not 2% inflation ignoring all of the things. Like they want what's best for Canadians. They believe that is 2% inflation, but they can kind of move around that target a little bit time-wise. It can be, we're gonna look at this over instead of a 18-month to 2-year horizon, 3-year horizon, because we think it'll put too much stress on consumers to bring it back sooner. So there is some flexibility there. There's still, I don't think they're as politically inclined as you do, but I think it's more just that there's some pragmatism now. Like, you know what? Sometimes we need to be a little more flexible than otherwise. And when that's the case, then fine, we'll do it. And now is kind of one of those times. That's why, I mean, they're again, providing as much support for the economy as they can, given the backdrop, given the inflation backdrop. And if the inflation backdrop changes, then they'll provide more. The oil means it's not going to change, at least not anytime soon, unless prices magically go back to $60, which I would be shocking for, I think, most everybody. And so here we are where we are. And yeah, next move, probably a hike instead of a cut. Uh-oh.
No, I mean, we'll see. Look, maybe I don't know anything, but
you know some things.
I just think it's symmetric is all.
That's fine. Okay.
Speaking of the big government machine. Should we talk about how we now have a majority?
Do it.
Well,
What do you want to know?
is the money printer turning on?
No.
Is the money gun? Can they come out now with free reign and
No.
spend? No,
They can.
Yeah.
I shouldn't say they can't. They definitely can. In theory, they could spend as much as they want. Not quite, but really, as a majority government, they do have free reign to some extent. Will they? I would be shocked if that were the case.
at all, or
At all, honestly. Yeah. So we'll get the spring update in 2 weeks. 2 weeks yesterday, and I don't think there's going to be a ton in there. We already got this gas excise tax holiday that costs 2.4 billion ish. You have the groceries and essentials rebate, also known as the GST credit, or was the GST credit, and that is getting topped up for the July payment and then getting doubled in perpetuity, it seems, for the next number of years. And that's a lot of money that they're handing out. Mm-hmm. And so you already have a good amount of stimulus in the pipeline. Don't forget they cut the lowest tax rate last July. And so you have these kind of incremental stimulus moves. And so there already is a decent amount done. They could do more if they want to. The budget numbers are tracking much better than expected. Mm-hmm. From April to January, the deficit's just over 31 billion. And the deficit projection for the year is 78 billion. They always stuff a bunch of expenses into March. So March on its own could be a $20 to $30 billion deficit. That's not an abnormal thing to happen. But it's still tracking way better than the 78. So there is room to spend if they want to, but they've made it clear that they're trying to be fiscally responsible. They're cutting public service jobs as many as is reasonable, like 10 to 15% cuts generally, and so like they've signaled that they want to be, I think, a little bit more fiscally responsible. And if you consider that, like, there's a lot of worlds in which I'm wrong about all sorts of things, and one of them I'll be wrong about trade. And let's say the trade agreement doesn't happen and things blow up. The response on the fiscal side is going to have to be enormous. Like, it would be absolutely crushing for USMCA to end, and you'd need a huge fiscal response. So you kind of have to save your bullets for that. Like for that scenario, if you're spending stuff ahead of time, you don't want to use that bullet until you need to, I guess, is kind of what I'm saying. And the reality, and then if the flip side would be like, if you do get a trade deal and then activity picks up, like, you're even that much more better off. So there's no, I think at this point you kind of need to wait. It's responsible to wait. So
I think, trading wise, I think that's probably a secondary argument for the steepener as well, right? Like, if once we get past USMCA, if there's accelerated forward-looking growth, that's great. Rates should be higher forward-looking.
Yep.
And if there's not, then there's probably sizable fiscal.
Possibly.
Which, again, should weigh on the belly of the curve, right? Let me ask you this.
Okay.
What probability do you assign, roughly, to sizable fiscal, impactful market pricing wise fiscal, without total collapse of USMCA?
Extremely low.
Extremely
low, like 10%. I don't know why it would be.
Okay.
I just don't know why they would do it now. It doesn't make any sense to me when there's so many unknowns still left out there, and there's enough stimulus already in the pipeline that will be supportive to kind of, again, I think the goal for now is just to kind of underpin the economy rather than really drive growth necessarily. The way they're going to drive growth is not through spending. So this is a total shift in philosophy from the government. It's not in spending to drive growth. It's going to be efforts to push forward projects in the private sector that actually drive growth through less red tape. Whatever it takes to push these projects forward are the things that I think we're going to see in this update and going forward from this government. So it's not big spending announcements. It's maybe they'll back loans, and that'll be one way to do it, but that doesn't cost any money necessarily. I don't think it's going to be direct spending from the government per se that's going to drive all this. It's going to be other measures.
Yeah. So the reason I ask you that question is it sounds like you think the growth picture is actually quite good with USMCA being restored.
Yes, if it is, then
1 year forward, 2 years forward,
think
3
it's
years forward.
far better, and I'm very hopeful on the government pushing things in the right direction, which is important. That's a key component to all this. Like USMCA helps. I think it helps. It's probably a little more. You get a temporary, pretty big boost as things kind of return to some quasi-normal, not all the way back, but you get some quasi-boost to trade and investment, and then after that, Canada still needs to be a better place to do business. Like we still have this aura. I don't want to. It's not really what it is. This kind of view, if internally and externally, that Canada is not an amazing place to do business. We're not friendly to businesses. That has to change, and until that changes, it's really hard to be super optimistic on Canada. I think that could change. I'm hopeful that it does change. We have a government that appears to want to push in that direction. I mean, they still need to make that happen. Hope is not a strategy, but that's pretty much all I have at this point.
I would agree with you that the stuff that Kearney said, it seems like they definitely are heading in that direction, which is, like, again, I say, so kind of all points towards like a cheaper belly of the curve. Like, I think these forward rates are fair to low if that is the case.
What if issuance declines a little bit? So as part of the budget last year, they announced also issuance for the coming year.
Mm-hmm.
It's slightly lower. So they've already cut their 2, 5, and 10-year auctions just slightly. And 30-year auctions were left unchanged. I can see in the spring update coming a little bit of a further reduction, given the better trend on the deficit. Refinancing is the number of Canada's maturing is much lower. That would already have been taken into account last budget, but it is much lower. There's room for more T-bill issuance. Globally, most governments have moved away from the longer end and trying to push a little more on the shorter end of things. And so Canada could do the exact same thing. The math of kind of shrinking the 30-year auctions a little bit works out pretty well from a benchmark size and auction cadence. I don't know about the belly necessarily, but more in the long end. It's possible in the belly. I think longs would come first. So it kind of depends on how much they need to
that's
move.
fair. But
does it so from the belly, maybe you're right. Things could cheapen there, but in the long end, I think it's kind of a flatter curve out there.
But sure,
like
I think you're probably right. But to me, that just means like these swap spreads are probably going to be wider.
Yeah.
You know what I mean? Like, I think like
less bonds.
Well, sure. Yeah. Mechanically, but I'm saying if you're preserving the kind of forward-looking policy rates of the next 3 to 10 years, sure, they can cut issuance all they want, but I don't think that means that 3 year forward 2 years should be 2.5%.
No,
right? Like,
where should it be? Where should it be?
I don't know, 3%, 3.25%.
I'm like 3-ish is kind of where I'm at the high end of where people think neutral are. It is. So I think it's like around 3.
Yeah.
It's 2.75 to 3. I think other folks at BMO have a lower number than me, but that's where I see it. And looking further out, that like it's hard to get rates much above kind of like 3.5%. I think at any point, unless things are really
need an exceptional shift in the growth picture there. I agree with that.
It's going to be
but
tough.
Yeah, I mean, I think you're right. Like in a great scenario, they cut issuance, and that's probably just bullish. I mean, I think swap spreads trade quite well regardless of any anticipated cuts to issuance. I mean, we've seen a ton of foreign issuance come back to Canada from the provinces over the last year, and I think that probably continues given what their budgets are. So I think like those trade well either way, but like I think if what you're saying is true and they do reduce it, I think they could trade exceptionally well. Like I know everybody says Canadian swap spreads are rich, but like without incremental supply, I don't really see a catalyst for the bear case there.
I think they can enrich more.
Yeah, exactly.
That's what I'm saying.
Yeah.
There you go. All right, we're in agreement. That's positive.
Yeah, how often does that happen?
Not as often as I'd like. Yes. Okay. What else you got? Anything? Any other trades on the horizon here that are going to be interesting, or we just kind of have to wait for this war to kind of totally go away and then see if the AI fears return, or it's more off to the races for risk and everything else into the midterms? Because I mean that's what President Trump wants, probably.
Yeah, I think I'm not sure which structure I like best, but I do like from a macro perspective. I think you're right in that once the markets have fully moved on from the war, or at least the war's impact, I do think we're going to be we'll be back to a very pro carry environment, particularly into the summer, into the midterms, etc. I think we'll see vol come off, and whether that's an argument for swap spreads, whether that's an argument for credit or for
It is.
I mean, it is, but I'm saying however you choose to express that carry trade, I think we'll be in a very decent carry environment come the late spring, early summer. So that's probably, assuming I'm right on the curve, once I'm out of that trade, I would probably look to kind of get back into the carry game into the warmer months of this year.
Okay, cool. All right, Chris. Thanks for coming on.
Thanks for having me.
Always appreciate it. And let's see, what's next? I guess next time, hopefully we can not talk about oil or war. Or,
yeah, hopefully it'll be a bit brighter.
Well, I would actually say the conversation was quite optimistic on Canada.
Yeah, that's true.
Thanks again. Thanks for listening to Views from the North, a Canadian rates and macro podcast. I hope you'll join me again for another episode.
The views expressed here are those of the participants and not those of BMO Capital Markets, its affiliates, or subsidiaries. For full legal disclosure, visit bmocm.com/macrohorizons/legal.